Hi, folks. Hi, folks. Welcome to the Weekend Investing Stock Market Weekly Review for the week ended 7th of November. The research desk this week put out these stories: Japanese 35-year market journey, powerful lessons, real cost of timing the market, how much does China need the US, and global gold reserves, a growing shift in central banks. So, a lot of content is available to you for reading and for getting some new insights. A disclaimer as always, please read fully, understand it, and then move forward in this video. And do subscribe to the channel. Let's look at some charts. So Nifty this week was a downward journey, 0.89%. Very recently, we had gone to above 26,000, and we were hoping that a new all-time high is possible. But the last 5 or 6 sessions have been on a downward slide. And if we see on the weekly chart, we were almost there at the previous high, and then a small cool off has happened. Maybe it is a retest of this trend line, and perhaps we will move up. I'm more probabilistic in that camp that we're going to move up uh, in due course. So 0.89% lost on the Nifty. S&P 500 lost 1.63% this week. There has been more talk about AI, having topped out or being in a bubble territory, where even OpenAI was seeking government intervention in some chatter which they refused later on. And semiconductor chips, etc., stocks have fallen quite dramatically in the last 1 week. Gold has been stable, minus 0.13% on gold, 12,082 per gram. Dollar index has been rising also the last few weeks. This week it was making some sort of a spinning top uh, at 0.16%. Once it breaks below previous 1 or 2 weeks low, the downward journey potentially can start. In the global indices overview, this is a unique data point in dollar terms across markets. It's not available anywhere. Uh, you can see this week, Brazil really did an outstanding performance at 4% plus, and Hang Seng was 1.2% up. Other than that, all markets were down. Nikkei the most at minus 3.8%, and Nasdaq at minus 3%. India was, of course, in slightly red, but nothing compared to Nasdaq and Nikkei. If we see over the last 1 month, Brazil is really doing well, 8.9% here, 4.3% on the Nikkei, and rest are not so consequential. Over a 12-month period, however, we find that almost all markets are in the positive except Nifty 50, which is slightly positive, and Nifty 500, which is slightly negative. And surprise, surprise, Germany, Japan, Euro stocks, Hang Seng, Brazil, these uh, indices have done really well in the last 12 months. If you go to the 5-year figure, however, India is pretty much in line with all markets. So see, the usual uh, commentary is that India is high growth country and hence it should be outperforming a lot of other markets. But just look at where the data is pointing to. That over a 5-year period also, I mean, we have done just about as much as Germany. We have done just about as much as Nasdaq, just about as much as Canada. So we really, I mean, either every market is sort of running at the same pace over a longer periods of time, or essentially, the money printing has gone so much overboard that every market is overvalued and money is just sloshing around here or there. Only Hang Seng has not performed in the last 5 years. Otherwise, all markets are reasonably up. Let's now look at the global indices momentum score. So Brazil is at the top, followed by Nikkei, Hang Seng, Nasdaq, FTSE, Dow Jones, and Nifty has, in the very short term, moved up from the last ranks to sort of the third quadrant, and that is a good sign for Nifty and India markets. Benchmark indices overview: in the last 1 week, small caps lost 1.7%, Nifty minus 0.89%, 500 minus 0.8%, Nifty next 50.6%, and mid caps absolutely flat at minus 0.09%. Let's see what has happened in the last 3 months. Last 3 months, we've made some gains, about 3 to 4%. Over the last 6 months, we are at 4 to 10%, 4 to 11%, and the last 1 year is absolutely mixed, with Nifty gaining 5%, but small caps losing 5%. In the sectoral overview, you can see that capital market stocks have done the best this week at 2.2%. PSU banks have done well on rumors of some massive mergers coming through for PSU banks, 2.1% there. And some ground has been lost on public sector enterprise stocks, CPSEs, tourism stocks, defense stocks, infrastructure, and rest are lesser of movers. In the sectoral momentum score, you see PSU banks, capital markets are right at the top. Then oil, gas, metal, autos, and real estate is there in the top quadrant. Um, and then you look at the bottom of the chart and you find that the usual suspects, media, tourism, IT, FMCG, CPS is also here now, energy, PSEs, all these have been consistently performing poor, whether it was 1 year, 6 months, 3 months, 1 month, or 1 week momentum. When we look at weekly advance declines, it is a poor picture. Declines are outnumbering the advances by a big margin of 60 to 80% declines versus the advances. And there is no recovery in the drop from 52-week high stats. Also, you can see that small caps and micro caps, especially, you have significant number of stocks, almost 40 to 50%, or even more than 20% drop from the highs. And it's only the Nifty where 50% of the stocks are less than 10% drop from the highs. In the percentage of stocks outperforming benchmarks, very poor performance in terms of the number of stocks outperforming the benchmark. So only 36% of Nifty stocks outperformed Nifty this week. So it's not a broad-based kind of a move what is happening. And anyways, Nifty did not move this week. So if we were to see, let's say, 3 months period, then you can see that 56% of Nifty stocks have actually beaten Nifty, which is a good sign. But other indices are still far behind. In the strength and weakness within benchmark indices, you can see 82% of Nifty stocks are in the golden cross, which is 50 days moving average greater than 200-day moving average, which is a good great sign actually. Nifty Next 50 is also at 70%, and all other categories are 58 to 63%. Above 70, 75% golden cross is a desirable place to be at. Uh, Death cross, of course, is mirror opposite of golden cross, where 50-day moving average is less than 200 DMA. So you can see almost 40, 42% stocks are still below where are in the death cross in the micro cap and CNX 500 space. Completely brutal strength is where price is greater than 25 DMA, greater than 50 DMA, greater than 200 DMA. That is 34% of stocks in Nifty 50. Goes down to 28% when you look at Nifty Next 50 and mid cap 150. And small caps are very, very low at low teens and 20%. Brutal weakness is very low in Nifty, only 10% of stocks in brutal weakness, 16 and 15% in Nifty and mid caps, and slightly more in small caps, micro caps, and CNX, but not a big worry factor yet on the indices. Examples of brutal weakness in large caps are TCS, Infosys, Wipro, Trent, Tech Mahindra. And in Nifty Next 50, we have IRFC, Godrej, CP, ABB, Indian Hotel, Shri Cement, Bajaj, HFL, Havels, Naukri. All these stocks are satisfying the conditions here where you need to stay away. Price less than 25, less than 50, less than 200 DMA. Is the trend improving or declining? So let's look at 200-day moving average first. It's absolutely flat, and there's a slight dip uh, since 3rd of November. So there's no change virtually, you can say, on the trend. And the smaller trend of 50-day moving average has moved down from near 53% to 46%. So the shorter term trend is moving down. The longer term trend is still, you can say, there's a marginal move out there. If we do the trend check across sectors, then you're finding that in the in the shorter term, PSU banks, real estate, metals, private banks, these have good number of 80% or more stocks which are above the 50-day moving average. And FMCG, pharma, IT don't even have 40% or so. So these sectors are, as a sector, not performing very well. Here the sector is performing well and most stocks are doing well. When we look at 200 DMA, we find that all these sectors on the left, which are doing better than the CNX 500 in terms of number of stocks, percentage of stocks, above the 200 DMA. So 86% of metal stocks are above 200 DMA. Financial services 80%, auto 78%, commodity 76%. So these are the places where you will find good buying opportunities. And on the flip side, IT, energy, public sector enterprise, pharma, here you have less than 50% stocks which are above 200 DMA. So you'll have to really pick very hard in terms of stock picks there. But in the spaces here, most of the stocks you will find are in reasonably fine trend up. In the FIDI stat section, FIIs have been again selling for the last many days. This week also, except the last day, there have been sales from FIIs. DIIs have been continuing to buy, so that's a good sign, and uh, that's maintaining the buying trend from DIIs. This is the last 1 month cumulative. So cumulatively, in the last month, FIs have not sold much, 2,300 crores only. In fact, it had gone up, but now it is virtually at very near zero, actually, I would say. Whereas DIIs have pumped in 66,000 crores in the same time period. So certainly, DIIs are carrying the torch for the markets. FI selling seems to be exhausting, and once FI buying starts in any sort of a continuous fashion, I think that will give a lot of tailwind to the markets with DII cash not going anywhere. So that's where we are this week. The markets are dull, but not, I won't say dull and out, they're dull and waiting. And perhaps we are waiting for some clarity on the US India tariff deal. Perhaps we are also waiting for some clarity on US and China deal. Perhaps also some confidence giving measures from our government leading to budget which is less than 2 months or maybe 3 months away. Those kind of talks, and whether PSU mergers, whether more divestment, all those themes are likely to come back in the next month or two, and that should give a market a reasonable support, it seems. That's all that I have for today. Thank you so much for watching this. Thank you so much for sending your feedback on all our products, our services, our research, our content. And certainly, one more request from me is to subscribe to this channel and keep a feedback loop on so that we can continue to improve whatever we are offering. Have a great weekend, and I'll see you next time. Thanks. Bye.